Welcome to the Significance of Wealth podcast, where we explore the evolving landscape of wealth management, private investments, and collecting as both a passion and potential investment strategy. In each episode, host Tom Ruggie, founder and CEO of Destiny Family Office, discusses these topics with industry experts, providing insights into the unique challenges and opportunities associated with managing significant assets. I'm Marty Salt, and today's guest is Nick Guerra, managing partner at Guerra Tax and Wealth Planning, PA. Nick is an estate planning attorney who specializes in helping high net worth individuals, business owners, and their families establish trusts and business entities designed to minimize income and estate taxes, protect wealth, and ensure a smooth transfer of assets. Nick holds degrees in accounting and law from the University of Florida and also has a master's of law in estate planning from the University of Miami. He built his expertise at two Am Law 100 firms advising high-profile clients, including Hollywood creatives, Silicon Valley startups, and Wall Street hedge fund managers. Before founding Guerra TWP, he was a partner at an Am Law 200 firm, leading its tax, trusts, and estates department. In this episode, Nick breaks down key estate and tax planning strategies covering tax minimization, asset protection, leveraged gifting strategies, and upcoming changes to estate tax laws that could impact tax planning and wealth preservation. Now here's your host, Tom Ruggie.
I am here today with Nick Guerra. Nick is an estate tax attorney. He is based out of South Florida, and I actually met Nick through one of our local offices that is in Boca Raton. And I found Nick to be a very sharp guy. He's become a good friend, very knowledgeable. And we're going to talk about estate tax planning today. So first of all, Nick, welcome to our podcast and thank you for being with us.
Thanks so much. Excited to join you.
So let's just start with the basics. What are the areas that you assist high net worth individuals with from a tax planning standpoint?
Yeah, so typically when clients come to us, they're coming to us for one of three things or all three things: tax minimization, asset protection, and proper estate succession. So they're general estate planning documents, making sure that their assets get to the right people.
So tax minimization, that perks everybody up pretty quickly, because I know I certainly don't enjoy paying the taxes that I pay while I'm living, not to mention at my death. So what do you do to potentially minimize taxes? And are you talking about just estate taxes, or are you talking about income tax planning as well?
So we do income tax planning to minimize state and federal income taxes. Sometimes that's involving C Corp stock, so QSBS tax minimization with qualified small business stock, using out-of-state trusts to minimize state income taxes. But a lot of times we're focused on the estate tax planning, and that is death taxes is what the estate tax is, the tax that's imposed over your estate at death if your estate exceeds certain asset thresholds.
So we've already talked a little bit about that, but maybe tell our listeners a little bit more about the estate tax and who potentially would have a tax like this levied on their estate.
So a lot of times our clients are surprised to the extent that the estate tax governs. So in the US, you're not taxed on receiving an inheritance. You're taxed on your ability to dispose of your wealth. And that's either during life, there's going to be a gift tax if you give away assets during life, or if you wait till death and pass your assets, there's going to be an estate tax or death tax. Mm-hmm. Either of those taxes, the gift tax or the estate tax, they're imposed at a 40% rate. And so as soon as you go over the free amount you're allowed to gift during life or at death, which is called the exemption amount, then there's a 40% tax imposed. And so a lot of times when clients come to us and they've already exceeded the exemption amount, the free amount that they can give away, every time they're making $1,000 post-tax, they're really only making $600 because of this looming 40% estate or death tax that they'll face when they pass away.
Yeah, so you mentioned the exemption. So there were some changes to that exemption that went in place under the Trump presidency, and there is a sunset provision on that as well. Tell us what is supposed to happen and then maybe potentially what you anticipate happening. Because I think there's a difference there, of course, with Trump winning the presidential election in November.
Right. So right now, that exemption amount, the free amount you can give away either during life or at death or a combination, that's 13.99 million per person. So everybody has the ability to give away about 14 million. Every year, it's increased with an inflation index. So last year, it was 13.61 million, now up to 13.99. And that is scheduled to be reduced to approximately 7 million at the end of this year, because Trump's prior law was going to sunset and is still scheduled to sunset or expire, bringing it down to 5 million index for inflation. So 7 million. However, with Trump coming back into presidency and a majority Republican position in the House and Senate, we guess that the exemption's going to be extended for some period of time, but it's likely that's not going to be a permanent extension if it is extended. And so at some point in the future, it'll fall back to that 5 million indexed for inflation amount.
Is there any reason that something like this couldn't be done as a permanent extension as opposed to a 4-year extension or a 6 or 8-year extension? What's the rationale behind that? Do you know?
Yeah, it's likely that there's not going to be enough votes in the Senate to make that extension permanent. And so similar to the Tax Cuts and Jobs Act, there's going to be a time where it's going to fall back. And that's because it's easier to pass an extension where it's limited to a certain number of years and they don't have to show as much revenue coming in as the cut is happening. Because if they extend the exemption amount, there's going to be less estate taxes due because less people will be subject to the estate tax.
If the extension is made, which I think is the common expectation of what's going to happen, that's probably going to save you from a ton of end of 2025 business to be done. Because my experience shows that when something like this happens, when we have a looming extension that doesn't get extended, of course, most people procrastinate, and it's, hey, on December 15th, what can we do to protect ourselves from this?
Right. And that's a very good point. So for the last 2 years, clients have known that this sunsetting was going to happen. And so we were doing gift after gift. With Trump coming into office, it slowed down a little bit, but almost everybody that we've done gifting for, you would want to do that anyway, even if there was an extension. And that's because you're able to take 14 million, remove it from your estate, and now all future growth on that 14 million is outside of the estate and not taxed. So if that turns into 50 million by the time you pass away, there's not going to be a 40% tax on the $50 million. And so for most of our clients who are at or exceeded the current exemption amounts, you'd want to make those gifts, even if you knew it was going to be extended. And even if you have less, you may want to do that, keeping in mind that it's likely going to be reduced at some future time. So you might as well use the temporarily high exemption amount, get as much assets out as you can now before it's ultimately reduced in the future.
Is there any difference from a planning perspective of working with a married couple household? You mentioned let's call it $14 million exemption. So that's a $14 million per person. Is there special planning that needs to be done to capitalize on both spouses' exemption, or does that kind of automatically take place?
Yeah. And a lot of times, sometimes clients are thinking about getting married and they'll get married just for tax planning purposes, because let's say I have $100 million and I get married to a spouse, I can gift to that spouse without using any exemption amount, because you can make free gifts between spouses. And now my spouse can use 14 million that I've given to her and make a gift to a trust and get that outside of the estate so that we can use both spouses' exemptions effectively. And the other kind of planning opportunity once you become married is that typically when you create a trust, you're going to pick beneficiaries, whether it's your children or other family members, and move assets into trusts for that person or people. And when you're married, let's say my wife and I could set up a trust for her benefit, and she can set up a trust for my benefit. I can give 14 million into the trust for her, and she can give 14 million into the trust for me. And so now we've taken 28 million that was previously going to be subject to estate taxes growing in our estate, and we've repositioned it into two trusts. And if we want to spend all the money, take a trip around the world, we can, because we're beneficiaries of each other's trust. So we get the have your cake and eat it too situation where we've removed the assets from our taxable estate, but because we're beneficiaries of each other's trust, we can still use all the assets if we need to.
So does somebody come to you for estate planning specifically when they've crossed the $14 million threshold, or if a couple's crossed the $28 million threshold, or when is the appropriate time, and perhaps even in conjunction with age, to start addressing estate planning?
So as your estate's growing in value, whether it's below the exemption amount, so a married couple, maybe they'll have 20 million and they're not up to that $28 million figure yet, but we're really going to analyze their specific facts and circumstances. So if they've got some private equity investment that they know is going to pop in value, it might be a good idea to gift it in trust while the value's low, even though they haven't hit their exemption levels yet. But usually we're going to be looking at clients who've already hit or exceeded the exemption amount, because if you're under the exemption amount, it may make sense to keep those assets in your estate, because anything that's taxed in your estate gets a free income tax basis adjustment to fair market value at death. So if you bought Google shares for really cheap in the past and they've appreciated in value, if you give them to a trust during life, there won't be an estate tax on it, but it won't get a free income tax basis step up. But if you keep those shares in your estate, taxed in your estate, when you pass away, the shares get an income tax basis equal to fair market value, and your beneficiaries could thereafter sell it without paying any capital gains tax. So until we're pretty sure we're going to save the client's estate taxes at a 40% rate, we don't want to interfere with the free income tax basis step up. So usually it's going to be once you're getting close to or exceeding the exemption amount when you want to look at doing estate tax planning.
Yeah, and what it sounds like is what you're typically looking for if you're going to make some gifts, is you're typically looking for assets that you would anticipate more growth over time.
Exactly. So when you're looking at, let's say you've hit that exemption amount and you want to remove assets from your estate, the first thing you're going to look at is, which assets do I expect to have the most appreciation? Because if I can give something away today that's worth 10 million, and in the future, I think it's going to be worth 30, then you get leverage on that gift. You're moving the asset, only using $10 million of your exemption, but ultimately removing 30 from your taxable estate. And then what you'd also like to look at is assets with a high income tax basis. But really the bigger thing is, which assets do you expect to appreciate the most? And you can give them away while they're valued low before they grow in value.
So what does the gifting process look like? Is it a formal structure? Obviously, you can make direct gifts to your children, but there's limitations on what you can do there. So tell us a little bit about the gifting process and what standard or typical recommendations are for getting some of those assets out of the estate.
So when clients come to us, a lot of times they say, I'm looking to gift assets to my children. And we always say, if you gift assets directly to your children or other individuals, number one, there's a loss of control. So you no longer have any control over those assets. Number two, if you give them to an individual directly, now you're just kicking the can down the road on the estate tax. So as soon as somebody gets that asset, it's going to grow in their own estate and be subject to estate or death taxes when they pass away. And there's other reasons why you wouldn't go directly to individuals, such as soon as you give it to them, the assets are exposed to their creditors and potentially to a divorcing spouse in the event of a future divorce of that donee. And so what we typically do is we'll move assets into an irrevocable gifting trust. That trust is going to be taxed to the creator. So there's no change in the ultimate income tax. All the income tax is reported on your 1040, the income from the trust. and the trust doesn't have to file its own separate return. And depending on the way and the assets that we're trying to move into this trust, a lot of times what we'll do is first capitalize an LLC, because if you give assets to a trust directly, the trustee that you appoint is going to have investment control and distribution control over those assets. But if you move the assets first into a holding company, the client can serve as the manager of the holding company and continue investing the assets as they see fit from a day-to-day process. And so you would capitalize a holding company and then move membership interests in the holding company to the trust. And also, by gifting membership interests in a holding company, a lot of times you can design that holding company with a 1% voting interest, and you keep that. And that way you have 100% voting control over that LLC, and you gift a 99% non-voting interest to the trust. And by gifting non-voting interests, you will suppress the value for gift tax purposes. So as an example, you could put in 20 million of assets into a holding company, gift 99% of that holding company to a trust. And because that non-voting interest has lack of control and lack of marketability, the value that you'll report to the IRS will be less than 14 million. So you can, in effect, use your $14 million exemption and get 99% of 20 million outside of your estate. So typically the gifting structure will be a trust with a holding company underneath, and a portion of the holding company is gifted to the trust vehicle.
So walk me through an actual example. I don't think my kids listen to this podcast, but in case they do, I'm using this as an example. But let's say I'm looking to gift $20 million, get $20 million out of my estate. It's going to go to my two children. So I understand the math, but I'd rather hear from you. What does that look like? How is it set up? What are the benefits to myself? What are the long-term benefits to the children from both a current and a future standpoint?
So you've got 20 million right now. You leave everything as is. Let's say that 20 million appreciates to 50 by the time you pass. So of the 50 million, 14 million
Better be
passes.
more than that, but anyways.
Yeah. And just assuming 50 million. So of the 50 million, only 14 passes tax-free. The balance of 36 million is going to be subject to a 40% death tax when you pass away. And so your children aren't going to get anywhere near 25 million.
$15 million tax. Give or take.
And instead, what you do is you create a gifting trust for their benefit. You capitalize a holding company with that 20 million. You gift 99% of the holding company to the trust using your $14 million exemption with valuation discounts. And now all you have in your estate is a 1% interest in this LLC. Now that 20 million's reinvested, grows to 50 or more. All of that value is outside of your estate. All you're taxed on is 1% of that value at death. Now you've got almost all of the 50 million in trust. When you pass away, zero estate tax on all of the value in the trust. The trust will break up into two separate lifetime trusts for your children. They'll get creditor protection, divorce protection, and none of those assets will be taxed in their estate when they die. And it gets better. Let's say the children grow their respective $25 million share to $100 million. At their death, no estate taxes. It goes down to their children in continuing lifetime trusts, your grandchildren, and creditor protection, divorce protection, estate tax savings. And if that's a Florida trust, that cascading dynasty trust design is going to last for up to 1,000 years. So you're in effect removing 99% of 20 million plus all future appreciation for 1,000 years from the estate tax regime. So it's a super powerful transaction if done properly.
Do you typically do it in a Florida trust? I know I see a lot of trusts using South Dakota and Nevada, but you mentioned a Florida trust. Do you have any thoughts or recommendation, or is this type of planning typically done within the state that you're domiciled in?
So for Florida residents, typically it will make sense to utilize Florida trusts
Okay.
because it's the most simple structure. Florida has great trust laws, a long duration of trust. The trust can last for 1,000 years. But if we're doing either, let's say, an asset protection trust where you benefit from your own trust, we might need to go to an asset protection jurisdiction like Nevada or South Dakota, Delaware. Also, for our clients in New Jersey, New York, California, there's a big state income tax. So sometimes we use Nevada trusts to eliminate the state income tax over those assets. And also in states like New York and California, there's a very short duration of trust. They can only last for a few generations. And so we'll use a Nevada trust to obtain a 365-year duration of trust so that you can take advantage of another state's law if better than your home state. But Florida has great laws. So generally speaking, for gifting trust for Florida residents, we'll use Florida Situs trusts.
All right. Nick, one of the things that you mentioned was irrevocable. Can you tell me what the irrevocable nature of these trusts are and how that comes into play from a planning standpoint?
Sure. So for tax planning purposes, these trusts need to be irrevocable. You can't revoke the trust or terminate the trust, essentially. For example, revocable trust that's done a lot of times in the general estate planning context to avoid probate, revocable trusts get no tax benefits. There's no income tax benefits. There's no estate or death tax benefits for those trusts. Everything's still included in your estate. You have full control of that trust. You could tear the trust up and all the assets are back in your name. So to get those estate tax benefits, creditor protection benefits that we can talk about, these trusts need to be irrevocable. So you're not allowed to revoke the trust, but we build in control features to allow you, even though the trust is technically irrevocable, they can be modified. So sometimes we'll build in a trust protector that can change the terms of the trust or amend the trust to get the best planning for tax law purposes if the tax law changes. They can also adjust the ultimate beneficiaries of the trust in certain circumstances. And then we give the creator of the trust the power to remove and replace trustees so that they can effectively change who is controlling the trust. So although they're technically irrevocable, we build in provisions to make them flexible to address future changes.
Yeah, and you mentioned creditor protection. So that is a topic that comes up pretty frequently with my clients. So if you could expand on that a little bit.
So almost all of these gifting trusts, they're going to get you creditor protection as well. Like I mentioned, if I create a trust for my wife, move 14 million in it, she creates a trust for my benefit, transfers 14 million into that trust. Prior to transferring the 28 million, those assets were in our names. If we got sued and a judgment was entered against us, those assets are exposed to the claims of our creditors. Immediately after we gift those assets in trust, now if we're sued, the creditor can't touch the assets because we don't have legal ownership over those assets. All the while, we can benefit from 100% of the assets. And if we're the trustee of each other's trusts, we're in full control of the investments and distributions. But yeah, a lot of our clients come to us looking for estate tax benefits, and they're happy to find out that they also get great wealth protection or creditor protection benefits through these trust structures.
And you just mentioned that they can benefit from the trust. So let's go back to my example. So I've gifted $20 million to this trust. Explain to me, have I lost access to that money? Do I have the ability to utilize that money? How is that typically structured to provide what would be considered the grantor of that trust? In this example, me, to provide me with potential access should I need it. Because I think for a lot of people, the thought of giving away the assets while you're still living could create cause for concern.
I would say that's the number one question we get about these trusts is, after I've given the assets away, what access do I have to those assets if I need it or if I want it? So if a spouse is a beneficiary of your trust, distributions can be made to the spouse, and then you can use them as a married couple. If you create a trust for the benefit of your children and grandchildren, or if you created a spousal trust and the spouse passed away, only the children and grandchildren are beneficiaries of that trust. And so they're the only ones who can receive direct distributions. However, we'll build in provisions that allow you as the creator of the trust to obtain tax-free unsecured loans from the trust. And how that would work is, let's say you gifted 14 million in cash to the trust. A year later, you may take $1 million loan from the trust to use to either for your own spending purposes or to make an investment. And you'll sign a promissory note saying, I owe you trust $1 million. And once a year, you'll have to pay interest to that trust based on the applicable federal rate, somewhere around 4% right now. But the trust doesn't have to recognize any interest income. And so it doesn't pay tax on that interest payment. And so if in effect, your payment of interest each year is just a free gift to your children and grandchildren. And if you pass away with that $1 million debt outstanding, your estate gets a deduction for $1 million. And so it reduces and minimizes any estate tax exposure as well. So it's either through a spousal lifetime trust structure where the spouse is a beneficiary, you can get distributions directly, or you can rely on tax-free loans from the trust to get access to those assets.
And Nick, you alluded to this, but I don't know that you went into detail. So again, I'm going to just continue to use my example. So if I were to gift 20 million to an irrevocable trust like you're talking about, what am I paying gift taxes on? In other words, I've got the $14 million exemption, but isn't there discounting available that reduces the amount that's actually utilized in that scenario? And if you could explain that a little bit.
Yeah. So if you were to just gift 20 million directly into the trust, 14 million is free. And then you're subject to 40% tax on $6 million that you'd have to pay the IRS the year after you made that gift. But if you were to capitalize a holding company with 20 million, and then you gift a 99% non-voting interest to the trust, so you're gifting 99% of the equity of 20 million to the trust, you can get a qualified appraisal over that non-voting interest. And because of lack of control, the non-voting member in that LLC doesn't have control over the LLC, and lack of marketability. There's not a free market to sell that non-voting interest. There's valuation discounts that will, and I would expect somewhere between 28% and 40% valuation discount on that transfer. So in effect, you're removing 99% of 20 million from your estate and moving that into trust, but you're only going to use 13 to 14 million of your gift tax exemption amount when you do that.
And that even applies towards things like publicly traded stock.
Yep, we do that a lot. So even cash, sometimes we'll put into an LLC. The valuation discounts won't be as big on cash as with marketable securities or privately held business interests, but you still get a valuation discount. Many times we'll just capitalize an LLC solely with marketable securities to make that discounted leverage gift to a trust.
Are there any other control factors that the creator of a trust has that you haven't mentioned?
Oh, like we talked about, we've got the ability to remove and replace trustees at any point with whoever you want. So if you created that gifting trust for your children and appointed a brother or sister as trustee of that trust, and they aren't following what you want them to do, whether they're not investing the assets how you want, or they're not making distributions to your children how you want, you remove and replace them immediately with anybody else that you want that's not related to you. There's a tax rule. You need to appoint an unrelated person. And also, we'll build in additional control opportunities through the use of that holding company by retaining a 1% voting interest. Now you can decide who the manager of that LLC is, typically you, but you can appoint somebody else. And now you've eliminated the trustee's ability to make investments. Now you are in control of those investment decisions. And then we'll also build in sometimes powers of appointment in the trust. So you can give a third party the power to reallocate the assets among your children. For example, if one of your children doesn't come visit you during the holidays, you can have that third party allocate the assets at your passing to the other child, or bypass that child and go directly down to your grandchildren. So there's a lot of bells and whistles we'll put in the trust to add to the control while keeping the trust irrevocable to get the desired tax benefit.
So even though I'm making this irrevocable gift out of my estate, I effectively still have control over the assets, control over the management of the assets, the ability to access the assets if need be. I mean, obviously, I think ideally you wouldn't want to, but certainly if necessary, I could. Are there any other benefits aside from that? I mean, those are great benefits in and of themselves, but is there anything else that I'm missing?
What I really love about once you've got the trust structure in place and the assets funded in the trust or through the holding company, now every future investment that you are going to make, and you see a really great opportunity for a pop in value on the future investment, you can make that directly with the assets of the trust. So instead of having to buy a private equity interest, get it appraised, gift it to the trust, you use the cash flow from the other investments to buy that asset anew directly in the trust. And now all future appreciation is out. So a lot of our clients, once they've got these vehicles in place, they're going to use the vehicles as their investment platform going forward. And we've built in all of these control features to allow them to handle the investment strategy, make decisions, remove and replace trustees. And the idea is not having legal title to the assets, but being in full control and having access to those assets. That way you remove the assets from your estate so they're not subject to death taxes, estate taxes at death. And if you're sued for some reason, even though you've got control and access to all of these assets, the creditor gets nothing because you don't own them for legal purposes.
Yeah. Very good. I think that's been a fantastic summary of estate planning and gift tax planning. So how would a client that needs to either get started in this process or maybe readdress the process, what's the best way to do so? And of course, also, what's the best way for somebody that would be interested to contact you directly?
So typically what we'll ask clients to do is reach out to us at info@guerratwp.com. That's info@gueratwp.com, like tax and wealth planning. And what we'll do is set up a complimentary Zoom meeting, get the specifics of the client's intentions, family structure, what they're looking to accomplish in their tax planning, wealth protection planning. And then we'll give them feedback and recommendations of what we suggest. So it may be one gifting trust, multiple gifting trusts. They may need general estate planning documents updated. And we always give a complimentary custom analysis of their plan and feedback with recommendations. And then they can decide whether to proceed with those recommendations or not.
Awesome. And you do a great job, Nick. I want to thank you very much for being on this episode with me. I also want to thank you for the work that you do for our mutual clients. Again, everybody loves working with you, and I think you do a fantastic job. Thanks again, and look forward to seeing you sometime personally soon.
And thanks, Tom. Really had a fun time being on the podcast.
Awesome. All right, man. We'll talk to you soon.
On behalf of Tom Ruggie and Destiny Family Office, we hope you enjoyed today's episode of The Significance of Wealth and will continue to tune into future episodes. Connect with us at destinyfamilyoffice.com, on LinkedIn, Facebook, YouTube, and Reddit, and recommend our podcast on iTunes and Spotify. Until next time. The expressed views, thoughts, and opinions in this episode of The Significance of Wealth belong solely to the host and/or guests and are not investment recommendations or offers to buy or sell securities or private investments by Destiny Wealth Partners or its affiliates. This podcast is for informational and educational purposes only. The funds discussed are typically for qualified purchasers, defined as $5 million of investment net worth, exclusive of primary residence.